Welcome to another installment of the Investing with IBD podcast. It's Justin Nielsen here, your host, and it is June 6th, 2023. We've got more interesting stuff to talk to you about in terms of what's going on with the market. And to help me do that, as he does every week, Arusha Paris is here from O'Neill Global Advisors. He's a portfolio manager there. How are you doing, Arusha?
I'm doing well, Justin.
Hanging in there. It's been a little bit of a crazy market. Things getting extended, a little bit more participation, the breadth that we've been asking for. So we'll get into that when we get into the markets. And to help us with that, we're bringing back on the show Will Rhind. He's the founder and CEO of GraniteShares. How are you doing, Will?
Doing great, thanks, Justin. Thank you for having me back on.
Yeah, great to have you. I mean, last time we had you on, it was really all about the commodities. You really kind of led us through platinum, palladium, what was going on there, especially with stuff going on in Ukraine. Now, since you've been on, I mean, we had this gold run for a while, and a lot of stuff happening with the Fed. Bitcoin all of a sudden became the flight to safety. I don't know what happened there. So we're going to have to get your help on dissecting a lot of these things. But let's start with the market. And Arusha is going to pull up the NASDAQ composite. We really have had this strong 2023 so far. I mean, if we just kind of ended year to date for the NASDAQ, you'd look at the index and say, hey, this was a good year. But under the surface, not everything's been participating. What's been your take on this market?
I mean, from my perspective, it's the big story is tech. I mean, this is the kind of reversal, I suppose, of really some of the worst or the worst affected sector last year. So yeah, I think people just saw that, for certainly the large cap tech names. I mean, you're talking about, some of the most, dominant, companies in the country in their sectors, companies that are hugely profitable, and companies that frankly people love to own. And so it's really a case of people buying back in, I think, to these stocks, and their earnings have been very resilient, and particularly when it comes to some of the new darlings, companies like Nvidia, hitting high market caps, and I think it just sort of really goes to show that you can't keep a good thing down for that long. And some of these companies perhaps are just too beaten up last year as we rush to this new environment that we're in now of much higher interest rates, or the highest interest rates that we've had for decades, backdrop of inflation. But maybe perhaps we sort of rushed a little bit last year, and some of these companies got punished a bit more than they should have been. But leaving that aside, I think investors have seen that this year as an opportunity, and that's really been the story of this year.
Mm-hmm. And so likewise with the tech stocks getting hit so hard last year, do you think that they may have run up a little too far this year?
That's always a possibility. I mean, it's difficult to say. Ultimately, earnings, as we all know, will dictate, whether this rally can sustain itself. And like I said, so far, I mean, the earnings have been really resilient. They looked a bit rocky for some of the companies, coming into kind of Q4, particularly last year. But so far, things have been really good. And so it just really will depend, absent some shock, of course, Fed raising rates again, catching the market by surprise, inflation surprising again to the upside. Absent something like that, I think it all comes back to earnings and whether we can continue to see, solid earnings from these companies.
Mm-hmm. And I guess that was the big question, I think, on a lot of investors' minds is with the specter of recession. The fear has kind of changed from the inflation side to the recession side. And certainly in this last earnings season, it seemed like we saw some big punishments happening, not on the earnings themselves, but on the guidance that was going forward. And look, we've had the yield curve inverted for, it feels like forever, and this recession talk, coming out. Now, on the other side, of course, you have a strong labor market. We saw those numbers come out last Friday, and the market kind of cheered. So it just seems like there's a lot of mixed signals here. And how do you kind of maneuver through all of those mixed signals?
I think it's tough. This is an environment where I think people are just so bearish that in many ways the contra position, to be bullish perhaps is the right one. And I've never really known a situation where people have been so negative on the market, but yet we keep kind of grinding higher.
Right.
And I've had this view for a while. I didn't think that there was enough in what had happened for it to be a sort of severe recession. Certainly in the time frame that people were calling for. It's difficult to see how that could happen, given, like you said, the employment situation is still very strong. And yes, I know there have been headlines of a lot of tech jobs being lost, and there's certainly things that give you pause. However, the numbers are still very small relative to the entire economy, and it's difficult to see right now with earnings still keeping up. Where this sort of severe downturn is going to come at the moment, and certainly through, I think, the end of this year. So I'm not going to say I'm bullish, but I think I'm sort of constructively positive on the market at this stage. And like I said, I've been saying that for the last 6 months, and I don't see the real catalyst for downside at the moment. If anything, you could have probably said the debt ceiling was an outlier, could have gone wrong, and I know lots of people speculating about that. But again, it got resolved. Like I said, I don't see where this catalyst is going to come from immediately. It's not to say that the Fed is not going to do something, in the next 6 months or so to raise rates too high, and that might cause a recession. All of that is possible, but I think for the moment things are okay.
What about the market rallying on just such a kind of narrow base, where it's just really a handful of stocks that are carrying up the market? And there are stats out there that if you remove those stocks, the S&P is up only 1% for the year. Do you see a potential chance that over the next couple of months that maybe you start seeing more of a broadening in this market and it really starts to become more of a bull market?
I think you could, Arushan. One of the reasons is because I think this is, in large part, the rally's been quite technical. In other words, because of the lack of breadth, I think it's a lot of combination of short covering from people that have been so bearish, and also performance chasing, by the investment community at large, who again have been underweight equities, particularly underweight tech. It's probably one of the most vocal trades of this year to be still underweight tech, and it's been a horrible outcome so far. And a lot of people have then had to chase the market up, as a response, because their portfolios are underperforming. So I think that definitely can continue as long as the earnings hold up in these companies, and I think that people can still chase this rally upwards.
Shifting a little bit to kind of the shiny metal, gold. We saw kind of a nice rally in gold, and again, kind of going with the normal correlation with the dollar, and of course we've been also looking at the 10-year Treasury, and keeping all of these things in mind. But a lot of people looking at gold potentially coming up to this big long-term high for decades. I mean, if you look at the monthly chart on this, it's kind of up at the highest level that we've seen in a really long time. Is this something where it went up too much too fast, like a lot of the tech stocks, or is it more of a, hey, this could be an opportunity here for gold to take on another leg up?
I don't think it's gone up too fast. I think that what's happened here is that it's coincided with the peak in the dollar. And so the dollar, staged this huge rally, which really sort of started to fade around the middle of last year. And, that largely coincided with, the market thinking that interest rates were starting to peak, or at least had a pathway to see how interest rates would peak. And then inflation numbers started to come down. And so the dollar's been on decline really since then. I think the gold market has really responded to that. Now, clearly, in the last few weeks, there was some extra air in the balloon, so to speak, because of the debt ceiling situation. I think that if those can remember back to 2011, when the debt ceiling situation ultimately ended in the downgrade of US sovereign credit for the first time, that sent gold to a high at that time. And I think there was some people that felt that clearly that could happen again. And the reason why you buy gold is to hedge against these things. So, some of the price appreciations come out of the gold market, since then, but it hasn't collapsed in any way. And I think that's just due to the macro fundamentals for gold are still very strong. In other words, the dollar is still on a longer term decline in my mind. Inflation, I think, is still coming down. And I think rates have peaked. And it doesn't mean to say that we can't get an extra rise, but I think the market's really, especially the gold market, is looking to, forward rate expectations. And, all of the forward rate expectations point to lower rates, within the next 6 to 12 months. So I think that the gold market's really telling you that even though the gold price is at a level which is up or near the high, certainly that we saw, back in 2020, that we can hold in here, specifically if we're talking about, a longer term decline in the dollar.
Yeah, and it's funny that you bring up the 2011 example with the debt crisis, because we were also, if I recall, in 2011, kind of facing a lot of global recession fears. During that time, I mean, there was, if I'm not mistaken, is that the time where the Greece,
right,
issue was going on, and it's like, hey, you've got to clean up your balance sheet. Germany was kind of pounding the table on them, and they're like, well, that sounds not fun, type thing. So a lot of extra things going on there. But that recession, I guess, I mean, the world market has been showing, some decent strength, not nearly the weakness and volatility that we were seeing in 2011. So I guess that's a good thing.
Yeah, I mean, I think 2011, 2012 was still recovering from the financial crisis, which was, it was an epic shock to the global economy. And, just some people could argue it's still working its way out of the system today, but that's probably for another day. But I think, certainly as soon as 2011, there was still a lot of shocks that were reverberating around the world. The world is still healing, from that. And like you said, European sovereign debt crisis was just one of those incidents that happened around the same time.
And it's interesting too. That was 3 years after the event itself. The 2008 financial crisis, and here we are, kind of 3 years after our COVID. Is there anything about that that's important?
I think, again, what you've seen. And part of the reason why there's a bit of a bifurcation in the economy is that, we clearly saw a group of companies within COVID that thought that, or let's just say, that experienced extreme demand. And the converse of that was a group of companies that had the exact opposite experience. And, that clearly created a lot of imbalances in the economy. And today, a lot of those companies which saw extreme demand during COVID, they therefore projected that would last forever and are still trying to rebalance. There's a rebalancing that's happened as those companies try and work through, whether it may be, excess inventory or subscribers that, disappeared or certainly plateaued. And then on the other side, particularly I'm referring to things like airlines, travel, services that just completely disappeared, but yet now there's very strong demand, and not only strong demand, but they're very limited in the fact that they can't bring on more supply. You can't just order, hundreds of new planes to fulfill demand from passengers on routes that are popular at the moment. And so, that's where we're seeing a lot of the inflation show up in the economy today, and certainly in the airline industry. How they've been able to keep pricing robust, keep margins there, is because there's no alternative. It's just a binary decision. You either want to go on vacation or not. And if you do, then you have to pay the prices. And those industries are benefiting now from the fact that they didn't, bring on or couldn't bring on more supply. And they're benefiting from that demand, surge that still is going on in those sectors.
Yeah, what's interesting though is that the major airlines, their stocks at least, haven't really gone on those really nice runs, unlike some of the more regional type of airlines.
The Ryanairs, the Copas, and so on.
Right, exactly.
Yeah, no, it's an interesting situation, but I think still that's the main part. When we look at the inflation picture, it's where a lot of the inflation is showing up in the economy, less so now in other parts.
Mm-hmm. Well, when we come back, we're going to take a look at some of the stocks that have been kind of top of mind for folks, and specifically how you might be able to leverage those positions. Will is going to chat with us about some of the products that GraniteShares has come up with recently that use leverage in ETFs. So stay tuned. We'll be right back for that.
The Direction Hydrogen ETF offers exposure to the top 30 pure-play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive.
Welcome back to the Investing with IBD podcast. It's Justin Nielsen here, your host, along with Arusha Piras, who joins me every week. He's an O'Neill Global Advisors portfolio manager. And we've got coming back on the show, Will Rhind. He's the founder and CEO of GraniteShares. And one of the things we were talking about, with such a strong move in such limited stocks, many people have been, thinking of, okay, well, instead of being all diversified in stocks that aren't working, should I just be putting my money in the winners? And maybe even more so, how can I place bigger bets on these? The use of leverage. Some people like to use options. Some people like to use margin. What's your take on leverage, Will, and how it can be used appropriately and not misused to do severe damage?
No, absolutely. So we have a suite or a stable of ETFs that are an interesting new concept really for the industry. And that's, what we call leverage single stocks. And as the name might describe, they are literally prepackaged leverage within an ETF on a single company. So for example, 1.5 times leverage on Nvidia or Coinbase or other popular stocks. And that's really kind of extending the leveraged ETF category from leverage ETFs that perhaps people know already, such as leverage on broad equity indices or broad bond indices, or indeed some of the individual commodities, to now individual stocks. And there are obviously a couple of benefits to this. One is the ETF wrapper itself, which we all know makes it easy for people to trade, whenever they want during the day or via a brokerage account. And certainly it makes it more efficient than having to open a margin account with a broker, which has been, one of the traditional ways that people have had to use to get leverage. Mm-hmm. But clearly, when you're dealing with leverage of any kind, whether it's an ETF, whether it's options, whether it's futures, you're magnifying your exposure to a particular stock or a particular index. So the reason you do that is because on the way up, obviously, directionally, if you're correct and the stock goes up, then you earn more because you have a leveraged exposure to that position. But on the other side, if the stock goes down or if it goes against you, you lose more because of the leveraged position. So it's definitely one of those things that, we always say is for sophisticated investors, for people that understand, how to use leverage, but can be very effective for those that are, have a high conviction view on a particular stock or earnings season, whatever it may be.
Mm-hmm. So I think the first question that probably most people listening to this podcast would have is, why don't I just stick with options? It has plenty of leverage. And there's a lot of knowledge out there. Why wouldn't I just do options instead of a levered single stock ETF?
It's interesting. I think, a number of reasons. I mean, clearly there are a lot of people who are very familiar with options and very comfortable with options. I still think, though, that by and large, that's still a small part of the kind of investment community. And certainly it's a higher level of education, if you want, kind of understand how options work, and indeed, how to access them via brokerage accounts. But ultimately, options are binary, and that means you either win or you lose. There's no sort of halfway house. You don't win some, lose some. It's just you're either going to make money or lose money. And I think that with leveraged ETFs, yes, they are leveraged, and yes, they share that, but they're typically, a lot lower or later leverage. So we're talking about 1.25 times, 1.5 times, 1.75 times in that case, and in some instances. And you can hold them in your portfolio, in your brokerage account, for as long as you want. In other words, you're in control of when you buy and sell. And unlike options contracts where, typically you might, the contract might expire worthless, way before, you have the opportunity to exercise. And so I think from that perspective, for people that I think enjoy options or know a lot about options, I'm not sure necessarily this will kind of change, what they do. I think it's more for people who look at or want to have leverage, maybe who try and get leverage via brokerage account, find that very, very clunky or inefficient, expensive, want an easier way of doing that, and or who simply use leveraged ETFs already and are very familiar with the concept, but now want to extend that to higher conviction, positions on individual stocks as opposed to entire stock market indices.
Mm-hmm. Now, I noticed that you were kind of talking about situations where you might be holding, these levered ETF single stock positions for a while. Usually, you hear a lot of, the experts and the advice telling you, like with the leveraged ETFs, especially indexes like TQQQ, which is triple levered on the NASDAQ 100. They say, look, this is the triple daily performance, but long term, you hold this and you're looking at contango, backwardation, and all of these things that can get you very different performance than you would expect. So it's kind of like warned against long-term holding. So what is it about your products here that kind of allow for a little bit better long-term holds?
Yeah, I mean, I think, again, this is where there's a bit of misinformation in the way that this is talked about. So there are sort of two really important concepts to understand. The first is just mathematically how these products work, and the way that they provide what we call a leverage factor. It just means the amount of leverage. So whether it's 1.5 times, whether it's 3 times, it doesn't matter. All the products will work the same. And that is to mathematically provide the stated investment objective, which is 1.5 times leverage or 3 times leverage. You have to do that over a given day. And so the only way you can achieve that each and every day, day in, day out, is to rebalance that position at the end of the day. And so by doing the rebalancing, you're mathematically making sure that you are giving the investor the stated level of leverage, or as close as you can get to that stated level of leverage. But what you're doing from a performance perspective is you're changing the linear relationship with the underlying stock that I think a lot of people intuitively think that they're getting. So in other words,
right,
if people think they're buying 2 times, Tesla or, whatever it may be, and they think at the end of the year, whatever happens, I should get 2 times the underlying. Well, that's different, because what we are doing, what everyone else is a daily rebalance. So your performance of the fund or the ETF will deviate because we're reinvesting the profits if the underlying goes up, the way we'd look at it, which we call compounding. And over time, the outcome of that may be different from the underlying itself. And there are just very simple things you can think about, environments that will more likely than not improve or discourage your chance of success. So a trending environment, for example, trending market going up is conducive to positive outcomes for this particular process. A trending market going down, conversely, the same thing is going to be very bad for you if you're levered to the upside. And then the one that probably confuses people the most is where you have a choppy market, where the market's going up and down and up and down, up and down. And with a higher level of leverage, that again can really hurt or impact returns because of this daily rebalancing process. So that's first of all just like how they work, and that's the reason why the state investment objective is always about 1 day, because that is what they're designed to do. I think where people get confused is that doesn't mean you can only hold them for a day. Mm-hmm. That's a very different concept, and it sounds quite similar, but it's a different thing. So what we always say is you should not hold them unless you're actively monitoring your portfolio, because when you're using leverage and you're talking about underlyings which are volatile by definition, you should be actively monitoring your portfolio and actively looking at these positions. So that again goes back to saying it's not that you can't do that, you shouldn't do that. It's just that we don't want people, buying and then, leaving the position for a year and then waking up one day looking at the portfolio and seeing, it's dramatically different from what they thought, and then sort of say, oh, hey, how did this happen?
Mm-hmm. Right. Yeah, well, is this a really kind of these single stock levered ETFs? Is that a pretty new trend that's going on? I feel like I haven't heard too much about it. So, I mean, how new is this, or has it been slowly kind of growing underneath the surface?
It's really new. We started doing this first products in the summer of last year, kind of late summer of last year, and then we released a second batch at the end of last year. So it's very new. Now, GraniteShares have been doing this business for a few years in Europe, obviously totally different markets. But in the US, yes, it's very new. So it's people will be familiar with leveraged ETFs on broad indices in the bond market and in the equity market, also on the commodity side. But we've never had this new category, which is providing leverage on single stocks, or individual companies. So it's a new concept for people.
Mm-hmm. And, real quickly, can we talk about going the other way? Because I know that one of the other things that's out there now are the single stock inverse, and sometimes those are levered where you can basically go short. And certainly there's a benefit there, especially if you're trading in a retirement account, for instance, where you're not allowed to go short. And now all of a sudden you have a way to do it without kind of running afoul of the rules.
Yeah, no, absolutely. And I think, these are becoming more and more popular, Justin, because it's not just, limited to professional investors. The vast majority of investors, including professional investors, can't go short. So they are restricted from going short for different fund mandate reasons. But when we have a situation like we had last year, where practically everything you bought was going down, having a short fund or a way to implement an inverse exposure would have been really useful for hedging purposes. And so I think it's something that people are learning more and more about, and will becoming more popular, but certainly a useful tool, again, in the active investors toolkit.
Mm-hmm. So what are the levered ETFs that you have right now on the different stocks?
So we have a stable of ones that we launched. Again, people always ask, why these particular companies, and it's not an exact science. Clearly, we have designs on launching a lot more, but we have Tesla, we have Alibaba, we have Coinbase, we have Nvidia, we have Meta, or formerly Facebook, we have Apple. So we have a few of the big names, and I think it's partly because they're companies that people are very familiar with. To explain to anybody what those companies do or who those companies are. They're very well owned, very well traded. But I think also they sort of represent slices of the market which are interesting to us. So Nvidia for AI has been the big one, this year. Alibaba for a China proxy, Coinbase for crypto, et cetera, et cetera. And so we've tried to nuance the selection as well by, I think, picking stocks which represent, something perhaps more than just a company to certain investors. And so again, it's just the start of, what will be a larger offering from us in the space.
Mm-hmm. And, with, the way that some of these work, I mean, certainly when you look at an ETF, I guess you kind of rely on arbitrage sometimes. If there's a larger spread, it's not as liquid. You don't, are there issues that come in here where maybe you're getting killed on the spread if they're not as liquid, or is that something that's improving? Are there I guess what I'm looking for are there downsides that people need to be aware of before they kind of go into these, things, buyer beware type things?
No, absolutely. I mean, first, the most obvious buyer beware is what we've talked about, which is these are leveraged ETFs. They're not regular run-of-the-mill unleveraged ETFs. So because they're leveraged, leverage also, in of itself is more risky than not leveraged. They have a daily rebalancing, a compounding effect that people need to understand. But beyond that, they're just ETFs, and therefore they have the same risks as most other ETFs. And like you said, if there's no trading volume in a particular ETF, you're going to have wide spreads. If you have wide spreads, that means your execution cost is going to be higher than a similar fund that doesn't have high spreads. And so that is just that is the common feature with all ETFs. With these ones, though, what's interesting is because they're inherently trading vehicles, I put them in a different category to regular ETFs. And it's not because they're leveraged. It's because I view them as being trading vehicles, and they're part of a trading toolkit. And it's interesting because we're catering to a type of investor that trades more actively. That doesn't mean they're a day trader or things like that. We don't need to talk in extremes. It just means that somebody who has an active interest in the market, who manages their portfolio more actively than your average investor. And so with that, I think comes this customer that likes to trade, or certainly trades more actively. And because of that, you'll see the volume in these particular products, can be, not always the case, but can be very high. And that reflects the fact that this is used more as a trading vehicle than, say, a traditional ETF, which sometimes can take a long, long time to get traction. And you're right, Justin, spreads can be high because there's just no liquidity or very low liquidity in the market. But in these cases, it's not necessarily because the underlying stocks are liquid. It's more that there's just a lot of natural demand, both supply and demand on the secondary market. And so if people look at the trading volume in these particular names, I think they might be pleasantly surprised versus some of the ETFs they've seen. And so it's not uncommon for us to trade more, let's say, value in a day than the entire AUM of the fund. So they're very, very well traded. And, I think, again, that goes back to it's more of a trading vehicle than a buy and hold, forever type investment.
Yeah.
And how are these traders generally finding out about these products? Because, I mean, they're so new that, this is like the first time that I've really heard about them.
It's a great question. I wish I knew the answer to that because, it's something.
Tell your marketing department, right?
I know. Yeah, no, it is. It's that tough kind of scenario, right? Where you have this product, you're trying to get it. It's more kind of that. It's just going to take time, right? And all of a sudden, it'll probably just explode. Kind of probably like the Qs what went through 20 years ago when they were introduced or whatever.
Yeah.
Right? People probably didn't trust it. I'm going to stick with my mutual funds, but then now, everyone's trading them left and right.
Yeah. I mean, what I can say is there's no doubt in this market, there's a community of, highly educated, sophisticated investors that seem to be able to tell exactly when something's come out that they want to trade or that they're interested in. And it can sort of capture the moment in a way that's unlike any other market that we're involved in. And, we always ask ourselves the same questions. I mean, of course, we issue a press release, and who doesn't? But it's not enough to grab people's attention. And there's obviously people that, know what they're looking for. You can find, obviously, with all the search engines, you can find that very quickly, now. And so I think if you're just, you manage to intersect that, that demand, with the right product, when people are looking for, hey, how do I get leveraged on Nvidia, or how do I play AI, as an example, that we've seen, and then the intersection is Google or Bloomberg or whoever it is will return, our leveraged Nvidia ETF. And for the right person that's looking for that exact thing, it's a perfect intersection. And then there's intent created and they go buy the product. That's the only thing I can think of, but that's not scientific. That's just a gut feeling.
Well, hopefully
Right.
ChatGPT is also giving those answers too, because a lot of people are starting to go more and more towards that.
Yeah.
Yeah, I think yeah.
Oh, no, go ahead, Will.
No, I think it's interesting because going back to one of the comments you made originally, Justin, about how are people using this, and why why might somebody use something like a leveraged single stock. And the Nvidia one's been a really interesting case for us, because there's actually been a number of articles written about this, that a lot of these ideas or themes or concepts, whatever you want to call them, in ETF world, that they're very hard to actually express in the form of an ETF. So you might have an ETF that is on, just to take an example, blockchain. We'll talk about AI in a second, but it might be blockchain. And an investor might say, well, that's brilliant. I want to play blockchain. I want to get access to the blockchain. So I'm going to buy this ETF. And then when they look at the underlying components, they might be quite surprised to see a list of companies, including maybe some of the global banks in there, that for all intents and purposes have nothing to do with blockchain. And it's the same thing that happened with AI, that clearly AI, phenomenal potential, something that everybody's talking about, but how do you invest in it? And there are AI ETFs out there. I think when people started to invest in some of these products, I mean, a good article is written about how people haven't participated in the pop. And the reason for that in many cases is that there aren't that many companies that are truly in AI or powering AI, at the forefront of AI. And what they've actually got is a broader tech basket, which is not the same thing. And that's why people have led to something like Nvidia, and obviously our NVDL, which has leveraged Nvidia, as a way for people to express a conviction view on something, and to say, I know exactly what I want. Here's the particular product, and I don't want to be diluted by a load of companies that ostensibly have nothing to do with what I'm looking for.
Yeah, more of the pure play. Well, very interesting stuff. When we come back, we're going to get a little bit more into some of these, and one of the big questions I think we're going to address in the next section is, why is the leverage factor different? So stay tuned. We'll be right back.
The Direction Hydrogen ETF offers exposure to the top 30 pure-play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive.
Welcome back to the Investing with IBD podcast. It's Justin Nielsen here, along with Arusha Pires, O'Neill Global Advisor Portfolio Manager, who joins me every week. And coming back to the show, we have Will Rhind. He's the founder and CEO of GraniteShares, and he's been talking to us about ways in which you can get leverage on single stocks with the use of an ETF package. And as I'm looking at your offerings here, Will, one of the things that strikes me is the leverage factors are very different. You've got a inverse, which we didn't talk too much about, but you've got an inverse, you've got a 1.25, a 1.5, a 1.75. Why the difference between them all?
The simple reason is actually it's a regulatory condition, and it comes out of a derivative rule that the SEC brought in a couple of years ago, and really it's about volatility in the portfolio. So to put it very simply, there's a test, and the more volatile the underlying stock is, the lower the amount of leverage that you can apply to that stock. And then conversely, if it's a low volatile stock, the higher the amount of leverage that you can have. But important thing to note, you cannot have more than 2 times leverage. So although you might see higher numbers like a 1.5 or 1.75, you're almost never going to see 2 times. And that's just due to the volatility test regarding the underlying.
And that's for a single stock, because of course you can get that in some thematic ETFs or indexes, but we're talking single stock here.
Exactly, on leveraged single stocks. Yes, exactly.
Mm-hmm.
So when you look at it, you see different leverage factors. That's the reason for it.
Now, volatility changes sometimes, though, in stocks. Sometimes it'll go through periods where it's more volatile and times where it's less volatile. Does that mean that the factor might have to change on your ETFs, or is it kind of like this is what the volatility was when we launched, and so that's what it's going to be?
That's it. So for the purposes of this particular test, it's all about before you launch.
Mm-hmm.
Once you launch, if market conditions change and it ends up certainly the stock becomes less volatile, you can't adjust your leverage upwards. You can only adjust it downwards. If the stock was to become more volatile and you were in danger, or you were breaking or in danger of breaking the derivative rule around that volatility test, then you'd have to adjust it lower, but not up.
Mm-hmm. Yeah. And so the timing here for some of these, I mean, again, we talked about how narrow the market was or has been, and you kind of came out with these at kind of a nice time where Meta has certainly been one of the standouts. Nvidia, Apple is at new highs. So I mean, in terms of your offerings, you're kind of in the right spaces. What made you choose those particular stocks?
Yeah, and again, we are not market timing geniuses or anything. This is something that we wanted to do for some time. We have this business in Europe. We just felt that with what was going on last year, it was time for us to try and launch this business in the States. And so through summer and the end of the year, we ended up launching the products. And of course, the timing has been great for anybody that's held those products this year. But I think when we think about the range, it's not just about the biggest companies or the most traded companies. We also try and offer a suite that changes or offers exposure to different investment themes and the logic behind it. So, for example, Nvidia is a big company, of course, but it's become a kind of poster child for AI. So if you want to play AI, there's Nvidia. Meta, everybody knows, Facebook, Meta, Alibaba or BABX that we have, and that's a really proxy for China, and particularly for China tech, which a lot of people are looking to get exposure to. And then you have Coinbase through our Cornell, which we thought was interesting because there wasn't a leveraged way to play crypto. And of course, those that follow the ETF market and the crypto markets probably quite closely will be well aware that there's been a long-standing kind of back and forward with the SEC and the ETF industry around launching a physically backed Bitcoin ETF. But up until this point, there's not really a way to play leveraged crypto, and so on and so forth. And we try and balance this is a popular stock, or this is a stock that has huge market cap, huge trading volume, with stocks that perhaps give people access to certain things.
So maybe we should just walk through a few of them. We can start off with Nvidia, since it is kind of the poster child, as you said, and it's definitely the hot stock right now. Just walk us through just the NVDL and it's 1.5 and kind of the demand that you're seeing here.
So the demand has been really quite phenomenal. We launched NVDL toward the end of last year, so it came out in December of last year. And as you rightly said, Arusha, it's 1.5 times the performance of Nvidia over a given day. And as we all know, ChatGPT came out and really GPT-4 changed the way that everybody thought about AI. Yeah. And as everybody will be able to know by now, became the application or the service that got to 100 million users faster than any other service in history. And I think, certainly from my experience, I go to a lot of investment conferences, a lot of investment events, do a lot of webinars, content, and I've never seen anything like it in terms of every single one of these conferences, events has been about AI in a way that, perhaps somewhat cynically, it was crypto a couple of years ago, but that has now kind of been replaced by this AI conversation. And Nvidia clearly is right in the middle of that. And as you guys know, the Nvidia GPU chips power ChatGPT, and that I think is what really got people excited, or one of the many things that got people excited about Nvidia, and particularly with relation to AI.
Okay, I mean, it makes a lot of sense, and I know Justin said before that perfect timing, and it was
Right.
pretty close to perfect timing here for Nvidia getting it out there.
Mm-hmm. And let's maybe just kind of talk about Tesla a little bit too, because okay, so Tesla, you've got TSL, so you've got 1.25 leverage on this one with your TSL product, and if you kind of compare it to the chart, you're going to see some differences. So I mean, we often tell people, look, if you're using technical analysis, kind of use the index, a follow through day on the index, or your timing indicator on the index itself, not necessarily on the leveraged. And I'm just looking at, like, for instance, Tesla got above its 200-day moving average line, just recently, like last week. But in this case, it looks like, TSL, the leveraged one, is getting up there this week. The 200-day has just appeared because it's only been out for a little over 200 days. Is there any of those technical factors that you find people kind of asking about, or is that more of the something that you guys don't really pay too much attention to?
It's not so much that, Justin. It's more, I think, technicals are much more, from an individualist perspective, they really appeal to investors in a different way. And so there will be certain technical indicators that are very important to some people, and that will be something they look at. And at the end of the day, the ETF, regardless of whether it's an ETF or not, is just a stock. And so from a charting perspective, whatever technical pattern or piece of information people look at will apply there as well. So it's not something that we necessarily focus on, but a lot of customers clearly do.
Mm-hmm. Now, we got to address the downside. We kind of touched on it a little bit, but Coinbase was down 12% today, and as much as it's awesome when you have an Nvidia that's going up, or a Meta that's going up, like it has been, there are those risks of when you see a downside move. So you've got CONL, and that has a 1.5 times leverage. So talk about what happens on a day where the stock is down 12% or more. What goes on, and what do investors need to be aware of with their levered stocks?
Yeah, so when you're 1.5 times leverage, on the downside, this is clearly the bad thing, or the negative thing about leverage, is that you lose more money than if you were not leveraged. And in this particular case, you have 1.5 times that particular loss. So whatever the stock is down, 1.5 times that is roughly the amount that you should expect to lose in terms of performance on that given day. So,
and looks like you did it right, by the way, because 12% down on Coin, and 18% down on CONL.
Yeah.
So it acted as expected.
But that is, in a nutshell, one of the reasons why people love these products is the volatility of these products. And so today, would you believe that we have a very, very negative day, and clearly coming off the back of the news yesterday that Binance was being sued by the SEC. Now we see the news today that Coinbase is now being sued by the SEC. So clearly 2 very negative days for crypto more broadly, but for these 2 companies. But the amount of volume that we saw traded today, unsurprisingly, was huge in Cornell. But a lot of buying, a lot of creations today. So people looking at the dip, so to speak, or the fall in the price, and using that as an opportunity to buy. So it's a sort of, it's always the 2 sides of the same coin. It's, do you buy? Is this a buying opportunity, or is it an opportunity to get out? It's really why I think people like products like this that have a bit more volatility about them, because it requires conviction one way or the other.
Yeah. So I mean, it gets me thinking here. Like, so say you had like an inverse ETF of like Silicon Valley Bank, back a few months ago. What would have happened to that ETF, when that bank collapses, when that ETF collapses, does it, I mean, just go straight up? I mean, how does that resolve itself?
Yeah, it's a great question. So, first and foremost, the ETF's not a magic recipe to get around the underlying, market conditions. And so the ETF literally will replicate the underlying. And so in that particular case, yes, the price of the ETF would have gone up significantly to a point where, of course, the underlying company went bankrupt. And so, while we'll never know what exactly would have happened to investors, but the chances are that investors also wouldn't have been able to get the money back from the ETF, and the ETF would have had to close for very different reasons. In other words, the ETF was so successful, kind of on paper, but ultimately, if the stock goes out of business, unless the market maker or the hedge provider was able to sell out before the close or before it got seized, you'd have to assume that investors would have met the same fate as any stockholder in the company, regardless of whether you were long or short. But it's difficult to speculate without there have been a live example of that.
And I'm not sure anyone wants to stick their neck out and be the test case for how that works out. I feel like we had that back in 2018 with some of the volatility products, where it was like, oh, this is how it works in a bad way.
But there are going to be these cases. I mean, no one wants to have the product, clearly, that's short, or in this case, long, leveraged against Silicon Valley Bank. No one wants to be in that situation. But of course, people get into those situations because there is a real need or there is a real use case at the time, and sometimes you just don't know. Who could have predicted Silicon Valley Bank, before it happened, that would be in the situation where the 18th largest bank in the U.S. went bust in a very rapid space of time. So it can be these events that really change the direction for companies very quickly. And for investors, you can either make a lot of money from that or lose a lot of money.
And to that end, I mean, again, no one necessarily saw Silicon Valley Bank coming, but a lot of the stocks that you're choosing, are certainly ones that people would think of as, well, this isn't going out of business anytime soon. I mean, Apple, Tesla, Nvidia, these are, not going away. Now, something like BABA, though, BABA itself, I don't think anyone is expecting that to go away, but there were those fears of a delisting in the US. How would something like that play out if you've got this levered BABA? And
great question.
Talk about that a little.
So again, all the ETF is doing is really passing through the economics of the underlying investment and applying leverage to it. So in the case of BABA, you just own exposure to a stock at the end of the day. It's the same stock that everybody else does as a shareholder of BABA. So again, hypothetical situation, it didn't happen, but we would have followed whatever corporate action rules would have taken place. So in the case of a delisting, I would imagine that what would have happened was we would have had to liquidate the fund.
Right.
And clearly at that stage, it was delisted. That doesn't mean the company went bankrupt. That just means that shareholders would have been returned, whatever their stake in BABA was worth at the time. And so almost like, when a fund closes down, and it closes down because it's not economically viable for the manager, but yet the underlying investments it has, if it's investing in, liquid stocks, those stocks aren't affected. And, the fund goes through a liquidation process where it sells those assets in the market, and the investors get redeemed at NAV. So I'd imagine it'd be a situation very similar to that.
Well, hey, Will, we really appreciate you coming on the show and sharing with us all of these different new products that you have. And I assume you've probably got more in the mix coming. Anything you can talk about what you've got on the docket?
We do, yeah. So we have a number of stocks that we would like to bring out. So we have, from the AI perspective, we have stocks like AMD, which we can still bring to market. We have some more traditional stocks as well, which we'd also like to try. I know the ones in our stable are really all technology stocks, but we have like Ford, other more traditional companies that again would be kind of interesting to bring out, I think. So yeah, we're working on those, and hopefully we can bring those to market sometime soon.
Yeah, and also on the inverse side, right? Potentially.
Yeah. I think there's certainly room for those products. We've seen the companies that there's a lot of demand for the long. Typically, there's also a lot of demand for the short as well, and particularly some of the companies are difficult to short for different reasons. And so again, we want to try and provide a service, provide a real tool for investors to implement what their investment strategy is.
And of course, people can kind of follow your progress on these things at your website, GraniteShares.com. Anything else they should be looking at?
Yeah, well, GraniteShares.com is a great place to start. But of course, we're an approachable company. So if people have questions, etc., on anything, please reach out to us directly.
Awesome. Thanks again for being here, Will. Really appreciate your insights on this kind of newer product offering, and good luck with those future things. It looks like you've done a good job so far. So
yeah, thank you for having me. Great to be back on. Appreciate
absolutely. And that'll wrap it up for us this week. I hope you've enjoyed kind of like a little educational lesson on some new stuff here. Next week we'll be back. Who's our guest? You know what? We'll kind of leave that as a surprise. So hope you tune in for that. We'll see you next time.